All right. Hello, everybody. Happy Monday. We are November the 18th, and we're going to get started here with Money Matters on Monday. I am your host, Hung Lu. I am with Cash Property. And today we're going to look at something that I love to do on my free time. And we're going to go through a couple of calculations, but all around the same idea here. So before we get going, just a disclaimer, okay? Before you go and implement any of the stuff that I'm going to share with you, please just go and check with another person. Okay, and then I do have a shout out. So last Friday we had our mastermind. We had a great session, and we had David Asselin from Inspect Canada come and present to the group on everything inspection wise about doing a residential and multifamily inspection. And David, because it's online, it's very difficult to get engagement from the group. And David was able to bring, do some show and tell with, some electrical stuff, some plumbing stuff, and just made the educational segment in this mastermind really, really entertaining. So thank you very much, David. So David is from Asselin Inspect Canada. So I will also put his contact in the chat. So if you do need a home inspector, a building inspector, please reach out to David. Yeah, a great group of people. They actually have super high Google reviews. I think it's like 4.8, which is, yeah, amazing to me. Okay, so we did that. Okay, so my goal with these sessions is really to, to help investors, people with money, make the best choice available with their money. And so it's funny because as I was putting this stuff together, somebody actually brought up the topic about buying a car outright in cash. And I'm like, no, that is the worst thing to do. And so I'm not going to talk about it on this session, but maybe I'll save it for the next one because I was already way down the hole on these rich dad, poor dad cards. So these are the cards from the Rich Dad Poor Dad game. And if you don't have that game, highly recommend that you get the board game. It's a board game, okay? Like if you love to read the book as well, Rich Dad Poor Dad book. But the cash flow game is one of the ways that I'm teaching my son how to balance a financial statement, how to understand numbers, and how to really, he's only 11, but he's able to read one of these cards and know if it's a good opportunity or not. Now, life itself isn't as simple as what's written on the card, right? But it gives you a great starting point. Okay, so I know that you're not able to see these cards, because of the camera quality. But what I'm going to do is I'm going to bring up the cards as we go through each one together. I've picked a few of my favorite ones, and we're going to go through them. Favorite doesn't mean that they're all great opportunities. I like looking at them and comparing what's good, what's not good, and why they're not good or why it is good. Okay, so let me bring up the first card and then we'll run through a couple of scenarios on these ones. Okay, so let's see here. So on the screen, you should see the first card, which is the condo for sale, okay? And it's a 2-1 bath. So up until this year, I would say that investing in a condo was not the strategy that I would promote, okay? However, my tone has changed around this because of the prices just being astronomical to get into real estate. So I would say that if you are, new to real estate, if you've got, less than 10 doors, then yes, acquiring a condo as part of your investment portfolio may make sense. Okay, just because of it's important to get in the market, stay in the market, and sit and grow your investment. Okay, so completely side tangent there. Okay, so with this card, what it's pointing out is the negative 24% ROI, cash flow negative 100, down payment is 5,000, and the cost on this, the purchase price is 60,000. Okay, now keep in mind that, like I said, the life isn't as simple as what's written on the cards. Okay, so these cards, what they're showing you is at a very high level, what your cash flow is at the end of each pay cycle. And this cash flow already takes into account all of your rental income, whether it's rent, laundry, parking, storage, or whatever, all of your income minus all of your expenses, including your debt servicing. Now, I'm going to use the word debt servicing as opposed to just a mortgage, because sometimes as an investor, we may be leveraging private money. We may be leveraging our HELOCs. So it's not just a mortgage that we have to deduct as part of the expenses. It's all the expenses, every single expense. So if you've got a lawyer who's managing this for you, if you've got a bookkeeper that you have to pay to operate this, that comes under your expenses. Okay. So all of your cash flow minus your expenses, that's going to give you your cash flow. So all of your income minus your expenses gives you your cash flow. Okay. This is a $5,000 down payment. And so you're like, okay, why are we getting a negative 24 ROI? How do we calculate that? Okay. Because at a very high level, that's all they're giving you. Like when you get one of these cards in the game, you have to decide, okay, am I going to execute on this? Am I going to take advantage of this? Okay. So let me bring up the Excel spreadsheet. Okay. And then we will run through what this calculation looks like. Okay. So on the screen now, you should see the Rich Dad Poor Dad calculation sheet. Okay. So this is something that I've just put together to show you how these cards are calculated out. Okay. So let me go in and I'll put in the numbers here. So the first thing you do is you're going to update the cost, and the cost was 60,000. Okay. The down payment was 5,000. Okay. The mortgage is automatically calculated, which is just the difference of your purchase price minus your down payment. Okay. This down payment is not just how much cash you've got to put in to the opportunity down payment. The way I would see this down payment is, what was your cost to close? So your land transfer tax, if you're in Toronto, you've got double land transfer tax. You want to account for that in your down payment amount. The down payment also includes your lawyer's fees, any realtor fees, any referrals that you have to pay, any renovations you have to do immediately when you take the property over. Okay. That all falls under this down payment number. These cards don't go into that level of detail. Okay. So your mortgage amount is going to be 55,000. So now in real life, okay, you wouldn't necessarily have your legals, your land transfer tax, all of that stuff taken out of your cost to get your mortgage. Okay. All of those extra fees that I'm talking about, it's on top of this down payment, but your mortgage amount doesn't include those things. Okay. So in the game, they don't take that into consideration. What I'm saying is that in real life, you do want to take that into consideration when you're calculating your ROI. Okay. So on this card, the cash flow is minus 100. Okay, so we have to update that. So the blue cells are the ones that we're updating. Okay, so here they're saying that we could sell it for 45,000. Okay, so if you follow me on the math here, we're buying it for 60 and we're selling it for 45. So you're not going to want to do that ever in real life. Okay. Now, there are situations in real life where you are actually forced to sell because you either just need the cash or divorce or, or you die. Okay. So if you're forced to sell and you're selling it lower than the amount that you purchased it for, that is a really bad situation to be in. You automatically would be losing $10,000 just on that purchase price. Okay. So then the high end on this card was 65,000. Okay. So I'm just going to put that in. So in this case here, if you were to sell it at 65, you would make about a 10K profit. This number is calculated by taking my 65, okay, minusing my mortgage amount. Okay. That's how much my mortgage is starting at. Okay. So in real life, your profit would be whatever your mortgage balance is at that time that you sell. So as the years go by, you're going to be paying down your mortgage, right? So this number will be bigger because if you hold it for, let's say 5 years or 10 years or 20 years, your mortgage should be, lower. Okay. So this profit amount will go up. Okay, so to calculate ROI, your return on investment, what they've done on these cards is they've just taken the simple formula, and what they're saying is your deposit, okay, sorry, your cash flow divided by whatever your deposit is times 12. Okay, so the 12 is assuming that you're getting this negative $100 every single month. And so I'm multiplying it by 12 to give you your yearly ROI. Okay. And so that's how you come up with 24%. So these cards, they go up to the whole number. So it's always good to look at it to like at least a decimal point. So that's how this negative 24 ROI came about. Okay. So with this, okay, if you're looking at this and you're still saying, okay, well, Hong, I don't know if this is a good deal. It is absolutely not a good deal. Okay. And the reason for that is because one, you have to pay negative, like you have to pay $100 out of your pocket every single month. Okay. $100 is not that much, but you're not making money. Okay. The other reason why it's not a good opportunity is because it's negative 24% ROI. Okay. The third reason is that your potential profit on this, because they're sort of saying, okay, if you were to sell it in the future, at the most, you could probably get maybe 65%. Okay. In real life, we never know what that is in terms of appreciation, although we can do a very good guess. Okay. That, okay, properties in Toronto, properties in, say, around Vancouver, will probably have higher appreciation than, let's just say, in Northern Ontario, where maybe we might see 3%, 5%. Okay. A lot higher appreciation than, say, in the prairies. Okay. So we can sort of estimate, okay, yeah, you know what? It's realistic to say, okay, if we buy something for 60,000 in Toronto, maybe in 10 years, it might double. Okay. Maybe in 20 years, it might double. Okay. So that's the thing that you want to consider here. So let's see. Okay, so selling has to do with appreciation. Okay, yeah. So I made a note here that, you know, whatever you sell it for is what's considered the passive appreciation. It's, you know, you could improve the property, so that's forced appreciation, but then as you're paying down the mortgage, and if you do nothing else with it, if it's growing, then you're going to make that passive appreciation. Okay, so let's go into the next card and see if we can find another opportunity that is good or bad. So here's the next card here. Let's see. Oh, this is not the next card. Okay, let me unshare this and I will bring up another card here. So, because I've got a bunch of different cards here to show you. So, oh, okay, let's look at this one here. Okay, and I've lost my share button. Okay, so here we go. Okay, so right now you should see another card. Oh, I think I just hid it from you. Okay, so on this one, it's another condo. Okay, now this one here, it's 53% ROI. So on the complete other spectrum, okay, of the last card that we looked at. $5,000 down payment again. The cost is 40, so it's gone down by 20,000. The cash flow here, look at this, $220 every single pay cycle. Okay, so now let's go and put that into the Excel sheet and let's see what that looks like, and we'll walk through the example there. Okay, so we're going to update this card. So the cost on this is 40,000. Okay, down payment's the same. The mortgage is going to be 35,000 and the cash flow is 220. Okay, and the selling potential range is also the same at the 45 to 65. Okay, so you can see here, the ROI here is actually 52.8. Okay, on the card, it's saying 53 because they rounded up. Okay, so the idea here is the same as the previous card. Your ROI is based on your 220, which is your cash flow, divided by your down payment that you've made. And then you times it by 12. Okay, so this is an annualized ROI. Okay, and if you were to sell this at the high end, okay, you would make at least 30,000 minimum based on your current, like the mortgage that you got originally. Now, as you pay this mortgage off, so let's just say this mortgage goes down to zero. If you sold it at 65, you would profit 65. Okay, so the great thing about doing this is that now you can compare the previous card to this card and get a sense of which one is a better opportunity. Okay, now if you're only looking at one or two opportunities here and there, well, then it's going to be hard to know what's a good opportunity when one comes by your way. But if you're looking at these opportunities on a regular basis, and if you're running your calculations using the same criterias, okay, you have to use the same criterias because you want to compare apples to apples, okay? And you don't want to be comparing oranges to apples because it's not the same, okay? So so those are the two condo examples. Let's see if we can bring up another one here. Okay, so let me share this B&B one here. So this is a slightly different opportunity here. Okay, so what we're looking at now is an Airbnb. So it's a property on land. Okay, so I'm assuming that this comes to the land, and it's a business, but it's a property, right? So it's like a motel, like an inn. Okay, so this one here is a 40% ROI. Okay, it can sell anywhere from 100 to 300,000, which is fantastic. Okay, your purchase price is 150, your down payment's 30, so it's a significantly higher opportunity than the condo purchase. Okay, and it doesn't really matter that it's a 5-bed 3-bath. Okay, because right now we're just sort of looking at the numbers. If I was looking at this in real life, I would consider the 5 beds, 3 baths, and how many kitchens. Okay, because potentially you can break this 5-bed, 3-bath into 3 1-bedrooms, or 3 1-bedrooms and a mix of 2 bedrooms or a studio, and then you just need to make sure that you add in the kitchen. Okay, and then the cash flow here is $1,000. Okay, so let's go put this into the Excel spreadsheet. And you're going to see, so even though that the cash flow is higher, because you've had to put in 30,000, your ROI is significantly less, okay, than the 52% ROI condo. So that's where you sort of need to compare, you know, what asset do I want to buy? Like, am I buying condos? Am I buying houses? Am I buying B&B? Okay, it's two different opportunities here. Okay, it's like comparing a B&B to a condo is like comparing oranges to apples. Okay, like not recommended. Okay, so let's go back into the Excel sheet and we will put the numbers in there. Okay. Okay, so here is the cost is 150,000. 3. Okay, and the down payment is 30. Okay, so now keep in mind that if you are doing renovations, which normally for a B&B or like for a transaction like this, you would need to have some additional costs besides your lawyers and bookkeepers. You may need to change the sign. You may need to do some like websites. You know, there's additional things that you're going to need to do to transition the property over to you when you take it over. Okay, the cash flow was 1,000. Okay, so there's your 40% ROI. And if you sold it, you could sell it for 100,000. Okay, so which if you sold it for 100,000, not a great time to sell. Okay, but if you could sell it for 300,000, okay, wow, this is where that passive appreciation, that hidden treasure in real estate, you can really see that here, because this passive appreciation is more than 100% of the cost. Okay, so this ROI number here does not include your appreciation. It doesn't include this potential gain of appreciation that you can see here. Okay, so that's the other thing to take away from these cards is that you cannot, so in real life, you're not just going to look at this 40% ROI and be like, oh, this is a great opportunity. It's not a great opportunity, because it doesn't take into the other, wins of real estate. Okay. And so this is a good segue for me to talk about my camping concept. Okay. This is how I remember things, is by coming up with these these quick words that mean something more than just what the word stands for. Okay. Even though I'm a big camper. Okay. So with this camping, you want to have, okay, so when you are doing real estate, you want to go camping. Okay. And that is cash flow, appreciation, and mortgage pay down, increasing net worth for generation. Okay. So you want cash flow. Okay. So if you're following along, this is what it means. Okay. So you want appreciation. Okay. And here we're talking passive and forced appreciation. Okay. And then you have your mortgage pay down. Okay. If you can get these three things with any of your real estate opportunities, that is so amazing. That's what you want. You want to be camping when you're doing real estate. Okay. So yeah, on these cards, we're only just looking at cash flow. Okay. So you're missing out on two of the major things that really should be part of your ROI calculation. Okay. So these cards are incomplete. Okay. So now let me share another one, because one of the things that we do is a multifamily one. So let's see if I can find, oh, here we go. Here's an apartment one. So let me share this apartment one, and then we will go. This should take us to the end of our session today. Okay, so here is an apartment building, 24 units. Okay, it's a 67% ROI. It can be sold for 600 to 960. Okay, the great thing that I want to show you about this is, look at this purchase price. It's 550,000. We're anticipating that we're never going to sell it for less than this amount. So there's always going to be appreciation in this particular case. Okay. And ideally, we want that to roll into real life too. So if you're buying a multifamily unit building, whether it's all residential or apartments plus some sort of commercial, that's absolutely fine. Okay. What we want to know is always for sure, if possible, okay, is that the future value of this building is always going to go up. Okay, the down payment is 50. So yes, significantly more than the condos, okay, more than the Airbnbs cases that we looked at. Okay, but you can't just look at the down payment. Okay, you want to look at your cash flow, what your ROI is, and we already looked at the appreciation, so that's fantastic. And because there's a mortgage on it, and because you're going to have 24 units, the tenants are going to pay down your mortgage for you. Okay, so you automatically have cash flow, appreciation, and mortgage pay down. Those are the three things that you really, really want. So in this multifamily apartment building, you have all three. Okay, so you're camping as you're doing real estate. Okay, so let's go and populate this into the Excel sheet, and let's see what else comes up as we're looking at this example. Okay, so the cost here is 550,000. Okay, so as you can see, like I've had my cash flow game, I want to say at least 10 years. Okay, so I don't know if in the new cash flow game, if these cards are updated to reflect new prices, but back then we could have bought, an apartment building, 24 units for 550,000. Yeah, maybe in the olden days. Okay, so the down payment is 50. Okay, the cash flow significantly higher, 2,800. Okay, so if we sold it, we're looking at about 600, which is fantastic, because automatically, worst case scenario, even if you're forced to sell it, you're still going to make at least 100K profit based on today's mortgage of 500,000. Okay, we could potentially sell it for higher at 960. Okay, so look at that. You're almost doubling, okay, your ROI, your purchase price here of 550. Okay, so let's just say you are able to pay down this mortgage in 10 years. Okay, so we're going to just do a brand new calculation here. Okay, so we pay off the mortgage in 10 years. Okay, so this mortgage, 550,000 plus we're getting the purchase price of 960. So we're going to make 460,000 plus, okay, we get a cash flow of $2,800 times 12 times 10 years. Okay, so in 10 years on this purchase price of, let's see here. Okay, yeah, so we can actually apply this to every example going forward as well. Okay, so if we put 10 years in here and we're saying, okay, we've paid off the mortgage in 10 years, so we're seeing this cash flow every single pay for 10 years straight, and we're going to sell it at 10 years, and we see this $960,000, okay, over 10 years. That means that we made 1.2 million in 10 years. Okay, so now we take that, divide that by 10. Okay, so we've made $129,000 per year. Okay, that is really, really good considering that we've only put in $50,000 at the very start. Okay, so your true ROI, okay, it's not just this 62%, because this 62% only is for your cash flow. It doesn't take into your appreciation and mortgage pay down. Okay, so what this is now telling you, okay, so now what we're going to do is we're going to take this formula, okay, and we're basically going to copy it over here. Okay, so what it is, okay, I'll just create a brand new one. Okay, what it is, it's your profit. Okay, so it's 129,000 divided by how much money we've put in, which is your 50. Okay, so that is 2.5%. It is not 2.5. You make that into a percentage, and it's 259% ROI per year. Okay, now if you, okay, so which is insane. Okay, so if you can do this, fabulous. Okay, now the thing to keep in mind though too is, let's just say in that first year you take this and you cash out this 50,000. So you've made, somehow you're able to refinance or get some sort of payout, some equity. Okay, you pay yourself this 50,000 back. Okay, now you have no money in the game. Okay, if that's the case, it doesn't matter how much you make per year, because now your ROI, okay, is infinite. Okay, that is the whole concept of infinite return. Okay, so that is all I have to say about these cards. Okay, I had a bunch of the sample cards to show you, but we're not going to go through all of them. Okay, because it pretty much all follows the same thought process. Okay, so I do not make any money from promoting the Rich Dad Poor Dad game or the cards or anything like that. I'm just a firm believer that this is Monopoly on steroids. And knowing my kid who's 11 years old can balance a sheet and can read these cards and understand them and be able to talk a lot more sophisticated than many adults that we encounter when it comes to financial matters says a lot about this game. Okay, so that is looking at ROI using the Rich Dad Poor Dad cards. I hope you enjoyed this session as much as I enjoyed trying to explain all of this on an Excel sheet. Thank you very much for watching. I'll see you next Monday. Thanks, everybody.